Hello, and welcome to this week's edition of Tax in 10 with me, Rachel de Souza, and Andrew Robbins. We are both tax partners in RSM's London office and have a wealth of experience in dealing with a wide range of private client matters. Your feedback is valuable to us, so do keep it coming, especially if you have thoughts on any topics you would like us to cover.
Rachel, I have been reading headlines in my favourite newspapers, the Daily Express and the Daily Mail, about the Chancellor making extraordinary draconian raids on people's pension plans. Now, I know that you're a bit of a pensions expert, so my question is, why haven't you warned me about this so that I could save this 55% tax charge that was apparently about to be imposed on me out of nowhere?
Okay, I hear what you're saying. We need to go back to some basics in order to explain what's going on. So when saving for your pension, you are allowed to have a pension pot value up to what's called the lifetime allowance. And if you go beyond that, punitive tax charges arise. Now, the lifetime allowance, or LTA, is simply a value set by the government. Now, when the pension changes occurred in 2006, the lifetime allowance was 1.5 million. And the expectation was that it would rise annually. And of course it did, reaching a peak in 2012 of 1.8 million. However, in successive years, it was reduced and it came all the way back down to 1 million. And then for the last 3 years, it has risen marginally and now stands at just over 1 million. Then in April 2021, Rishi Sunak, who was then Chancellor, announced that the LTA would be frozen until 2026. And then Jeremy Hunt announced last year that it would remain frozen until 2028.
Blimey. Right. So, if I sort of work my way through all of that, you seem to be suggesting that this pension raid might not be as dramatic as the Daily Express suggested. I have to tell you, Rachel, that I am shocked to hear that. From what you're saying, this seems to be kind of an extreme case of fiscal drag, with tax being raised by letting inflation outpace increases in allowances. I'm still not clear where this 55% figure comes from, though.
Yeah, true. Let's tackle that last point first. If your pension pot is greater than the lifetime allowance and you take that excess amount as a lump sum, the tax charge on the excess will be 55%.
Right.
If you leave the excess in the pension so that you can draw it out as pension income, the tax charge on the excess is 25%. However, you will also pay tax when you draw out these excess funds.
Yep.
Now, mathematically, if the top rate of tax is 40%, on each £100 of excess, £25 will have been paid when there is what's called a benefit crystallisation event, broadly, when you draw your pension. So you've got £75 left of that excess. If you then pay tax at 40% on that 75, a further £30 of tax is paid. So overall, you have still suffered 55% on the excess. Now, these rules were designed when the top rate of tax was 40% rather than the 45% that we have now.
I'm loving this episode because you are sounding nerdier than I am today.
I don't like the sound of that.
So what you're telling me is that if my pension pot is too big, I will either take out the excess immediately and pay 55%, or take it out over time and pay a combination of 25% and 40% effectively. I mean, that doesn't sound great, but I'm not sure it amounts to a raid on pensions. And from what you're saying, it's certainly nothing new.
Actually, it's a little worse than what you've said, because if you opt for pension income and you're an additional rate taxpayer, you'll be paying 45% on that £75 in the example, and that actually gives you an overall tax rate of 58.75% on the excess. the point here is that these rules on taxing the excess have actually been in existence since 2006, which is when, you know, the current version of the pensions legislation was introduced. So to your first point, yes, I think you're right. This is an extreme case of fiscal drag. But of course, equally, it's really difficult for taxpayers to predict how their pension pots are going to grow over time. And so it's impossible to know whether the pension contributions that you make today will ultimately lead to these, you know, what are relatively penal rates of tax.
Yeah, and that does seem kind of unfair and arbitrary, because effectively I've got no control over the extent to which my pension pot will grow. I can only control the contributions going in. I guess, though, on the other hand, you know, a pension pot of £1 million is out of the reach of most people in the UK.
Yes, that is true. But equally, you know, I'm not sure that as someone who has enjoyed an above average salary, I'm going to be absolutely whooping with joy if my £1 million pension pot only buys me an annual pension of about £40,000.
Yeah. And actually that leads me on to another problem high earners may be facing, I think. So not only have we got this lifetime allowance that you've been talking about that we need to think about, but there's also an annual allowance, which I think is the level of pension contributions you're allowed to make. And isn't there also a problem with that for high earners?
Yeah, so let's just be clear. The annual allowance is an upper limit that you are allowed to save in your pension each year, which attracts tax relief. Okay. And the problem here is that the annual allowance tapers away where your earnings are above 250,000.
Mhm.
And once they reach 312,000, your annual allowance is reduced down to £4,000. So if you have your pension contributions automatically deducted from your salary, as many employees do,
Yep.
high earners need to be checking whether they breach the annual allowance each year. If they do, the excess contributions have to then be reported on the tax return, and you will then get a tax charge, which effectively is clawing back the tax relief you've been given by making your pension contributions through your salary.
Yeah.
Now, there is actually some good news. Many of our clients who are high earners have some form of fixed protection. Now, these protections are beneficial for those people whose pension pots had grown up to or beyond the lifetime allowance when, in those later years, the lifetime allowance value was reduced.
Mm-hmm.
So generally, the position was that a claim had to be made if you wanted to benefit from one of these protections. And so you're going forward, your pension pot would be protected at the fixed protection amount. Now, because there have been so many changes in the lifetime allowance, there are various different types of protection that clients could have. Some are protected at 1.8 million, others at 1.5 million, and there's another level at 1.25 million. But in order to retain these protected amounts, generally the taxpayer was not allowed to add any more contributions to their pension pot.
And this then, as I understand it, comes back to another problem, because as you were saying, for example, if you've got pensions being automatically paid through your employment, it's actually pretty easy to find that contributions have been made on your behalf, so by auto enrollment or when you're changing job or something. And in principle, a single extra contribution made accidentally now by your employer could result in the loss of that 1.8 million protection, and then potentially you're paying £800,000 at 55% because of a single simple mistake. My understanding is that this is a case where actually the good news is HMRC seem to be taking a pragmatic approach. And I think where it's obvious that the taxpayer would not have breached the terms of their protection if they'd known what they were doing, HMRC seem often to have accepted that the breach itself doesn't impact the protection. So they're kind of allowing you the benefit of the doubt in some cases.
Yes, that's true, and I agree. We've definitely seen cases where HMRC have taken that view, which is very good news. But I think overall, as I think we've discovered today, the key points are that saving for your pension is not actually as straightforward as it should be. Pension specialists have been saying for some years now that the current system really does need another overhaul.
Mhm.
However, to be honest with you, I really can't see that happening for a while yet. I mean, it really is just incredibly complicated. Thus, all I would say is you really need to have your wits about you when you are looking at your pension planning.
And maybe don't believe everything you read in the Daily Express.
Yes, very true. Very true. Now, on that note, have you got a recommendation for us this week, Andrew?
I do. As you know, I had my father staying with me recently, and the two of us of an evening sat down and binged on the new BBC series Digging for Britain. So this is a 6-part series available on the iPlayer where they go around the UK and they look at different archaeological digs across the country, different periods, different situations, just little sort of 8-10 minute segments on each one. It's really easy viewing. If you've got any interest in history or archaeology, it's a real pleasure. So Digging for Britain.
Oh, okay, good. I was beginning to think you'd gone all Monty Don on me and started getting into gardening.
I think not.
Anyway, thank you for listening. Please let us have your comments and feedback, and we can be contacted on rachel.d'souza@rsmuk.com and andrew.robbins@rsmuk.com. See you next time. Bye.
Bye.